My name is Garth Mackenzie, and I'm a technical analyst and ETF strategist at Traders Corner. Today, I'm revisiting the chart of the S&P 500 following Monday's deep sell-off, and I'm going to look at the levels to monitor this week and in the week ahead for a possible scenario to look out for. There's some meaningful technical damage that has occurred on the S&P 500 as we approach the end of this month. First up, it's a daily chart of the S&P 500. I'd previously flagged my concerns about the fact that the market was rising on declining volumes, and there was negative divergence evident on the RSI, which was not confirming the new high on the index. I felt that the setup left the market vulnerable to a pullback as the upside participation in the market was beginning to dwindle. We've now seen a major crack appear on Monday when the market gapped down sharply and ended the session down 3.5%. That gap lower is significant for its size and the large volume that accompanied Monday's selling. There's now also a clear break of the uptrend that has been intact since October of last year, and that break below the 50-day moving average is also significant. Monday's move lower also leaves the S&P 500 now flat for the year to date. The 3215 level is important lateral support, and that's the support level that we need to now watch in the week ahead. The break of the uptrend is also significant technical damage that we cannot ignore. The underside of that prior uptrend may act as resistance into any bounce into the end of this week. If we zoom in a bit more closely here, then I want to look at the 4-hour chart of the S&P 500. This chart shows the significance of that 3215 lateral support level more clearly. That level is the swing low from late January. It seems we get a bounce off that support level now, and that bounce will probably make an attempt to try and fill or partially fill Monday's big gap to the downside. The top of that gap sits up at 33.30. How the market then trades following an attempt to fill that gap will be very telling for the weeks ahead. If the bounce that follows now is a dead cat type of bounce that is met with selling pressure into Monday's gap, then it's possible that the right shoulder of a head and shoulders pattern might begin to form, with the neckline of that pattern sitting at 3215. We'll need to monitor that possibility very carefully in the weeks to come. Let's then zoom out again and have a look at the longer-term daily chart of the S&P 500. Here, I want to specifically focus on the way the index mean reverts back to the 200-day moving average over time. Over the past 2 years, you can see how the market has reconnected with the 200-day moving average on several occasions. It's been quite stretched from the 200-day moving average for the past 4 months. If this recent crack in the market still has further to run, and then we've begun to see a correction in the price of risk assets, as I suspect we have, then we can't rule out the potential for the market to reconnect with its 200-day moving average sometime in the late first quarter or second quarter of this year. That would then mean a retracement to around 3,100 on the S&P 500. The key level to really watch in the weeks ahead is going to be 3215. If that level is broken to the downside, then it'll open further potential for corrective action in the medium term. That's all that I've got for you this week. I'll be back next week with further market analysis.